Have you ever placed an ETF trade and wondered who's actually on the other side of this? You're about to meet the unsung heroes of ETF liquidity, the market makers. These are the players working quietly in the background to keep your ETFs liquid. But who are these market makers really, and how do they keep ETFs liquid even when the trading volumes that you might see look light? What if I told you those trading volumes don't really tell you the full story of what's going on with ETF liquidity? I'm Danielle Neziol with BMO ETFs, and today on Market Insights, we're going to talk to an ETF market maker about what really matters when examining ETF liquidity and how ETF trading actually works. But as a reminder, today we're not providing advice or investment recommendations. Today's show and all our shows are about investment education for Canadian investors. That market maker that could be on the other side of your ETF trades might be Valerie Grimba, the Director of ETF Strategy at RBC Capital Markets. Valerie is here to answer all our questions about ETF trading and liquidity. Valerie, thanks so much for joining us today.
Thank you so much for having me, Danielle.
So let's start with the basics. What is ETF liquidity and why is this a really important concept for investors?
ETF liquidity is really about understanding how ETFs can tap into a different pool of liquidity, and it makes them quite different from the on-screen liquidity you might see when you're buying a stock. And so, there's a few key features here, and it's very important for anyone who is going to interact with an ETF, either buying or selling an ETF, to understand what that true liquidity looks like. And we often, when we think about it and use an analogy, it's like an iceberg. So what you see when you pull up a ticker or an ETF ticker, you can just see the top of that iceberg when you see what is on the bid and what is on the offer and where you can transact that. But the reality is, in the ETF market, much of this liquidity is located below the surface. So as an iceberg is, if something like 80% of the iceberg is underwater, the same kind of applies in ETF liquidity, in that there's a lot of extra liquidity that can be accessed that's not available on screen when you immediately pull up a ticker.
The iceberg metaphor, I love it. It's a classic metaphor for ETF liquidity. Yeah, like the DIY investors at home, they only see that tip of the iceberg when they look up volumes and trading. They don't see really the depth of liquidity that's below the surface. Val, you're an ETF market maker. We see you on the trading floor right now. What do market makers like yourself, what metrics do you look at to assess liquidity?
Yeah, so the key feature that we really use in our pricing mechanism and all of the systems that we use behind the screens really is the underlying liquidity of what the ETF holds. So if you think about something very liquid, for example, let's say NASDAQ 100 stocks, these trade intraday at the millisecond. There's a lot of trading that happens. And so if you are buying a NASDAQ 100 ETF, it's very easy for us as market makers to go in and access that underlying liquidity. Something that might be a little bit more difficult to trade would be something like a CLO product, or something that it trades by appointment. So it's a little bit difficult for us to go out and immediately access at a certain price point. And we have very sophisticated trading technology that happens in the background. We're calculating all these different metrics and price points at any given moment when the trading day is on. We calculate what a fair value is, what we think the assets that are held in the ETF are worth. And then we provide both a bid and an offer, two-sided markets at which a person can buy those securities or sell that ETF. And we put into account the ability for us to really tap into that underlying liquidity we've been talking about.
So a lot of investors, Val, they think that because an ETF trades on the exchange, it has the exact same type of liquidity as a stock would. But you and I know that's not true. ETFs have, we like to say, there's three different layers of liquidity. So how is an ETF liquidity different than just a basic equity trading?
Yeah, it's a very, very key differentiator. And so if you think about a stock, this is called the secondary market, and that's because the number of shares that exist are finite unless a company does a primary offering, which is them coming to market and effectively making more shares. But the reality is that when you trade a stock, there are 10 million shares available. And so if you are buying or selling, you have the ability to kind of push up the price or push down the price depending on kind of what the market is doing or what people are doing when they transact in that stock. ETFs are very, very different in that we can go out as market makers and interact with the underlying. And this kind of has a muting effect. There's the arbitrage function as well that keeps all of us market makers engaged to what that price looks like based on the ability for us to create and redeem an ETF. So, what does that actually mean? It means that we can go out and gather the underlying securities and then deliver those securities to the asset manager, like BMO Global Asset Management, and you will effectively create new units of that ETF. And so you might just see something like 5,000 shares have traded, or the AUM looks a little bit small. But the reality is that we can access this pool of underlying liquidity and we can create or redeem or kind of destroy ETF in the secondary market. And again, this just kind of creates that iceberg, that big amount of liquidity that we can access as market makers and within the ETF structure that makes it very different from kind of overall momentum that you might see in a stock and the liquidity of a stock.
Right. So those three layers, just to reiterate, a buyer and a seller could meet on the market, and that usually happens for the most mature ETFs, $1 billion plus. Quite often, a market maker will be on the other side of that trade. That's the second layer of liquidity. That could be like you, Valerie, on the other side of a trade, meeting an investor. But that last layer, the create and redeem mechanism that you just described, which is unique to ETFs because they're open-ended funds. Let's dive into that a little bit more because I think a lot of investors they really don't understand this layer of liquidity. You have a really great analogy about making chocolate cakes. Can you describe a little more about create and redeem with that great analogy?
Yeah, again, I think it just helps because it does get really kind of sophisticated very quickly. And we kind of want to make it easy for everyone to understand how ETF trading is very different from just transacting in a regular stock. And so the analogy I like to use is imagine you walk into a grocery store bakery and you want to buy 5 cakes because you're having a really big party. And you go there and they only have one chocolate cake. You think to yourself, well, I want to buy 5, so I can't buy 5 if they only have one. But the brilliant part is at the grocery store, for example, as the market maker, we have access to all the ingredients. We have access to all of the underlying securities. So if you come in and say, I want 5 cakes and I only see one, well, a very quick turnaround, I can go out, shop the shelves, pull out flour, pull out eggs, vanilla, whatever you need, and make those cakes for you. So just because you don't see it on the shelf or on screen immediately when you pull up a ticker, it's not something an investor should be immediately concerned about because market makers can interact with that flow. We can interact with the underlying securities. And, I would say like this comes back to then like trading best practices. Like how do I make sure I'm tapping into that properly? And one thing we like to use is a limit order. And that's because market makers, we can go and the term we use is like reload. So we might just put our 1 cake on the shelf because what's the point of putting 5 cakes on the shelves if I don't think I'm going to sell all those cakes? I don't want to go out there and make them. But if you come to me and you say, like, I need 5, then I can reload and keep putting additional volume out on the bid or offer side, or if you're selling on the bid side, and get you done and get those cakes made for you. So there's a lot of flexibility within the ETF structure. And as an individual investor, you need to understand the liquidity of the underlying. So, like, that would be the thing that I would also tell people to focus on. And if it's a very large liquid pool of securities that trade very frequently, it's very easy for us to, again, go get those ingredients and make additional ETFs for you.
Such a great analogy. I love it. Makes it really clear to express what create and redeem really means for the ETF space. Last question for you. I know a lot of do-it-yourself investors, they like to look at volume metrics. They're on Yahoo Finance or whatever information they can access, but you have a different look at things. So can you just describe to us as a market maker, when you're looking at an order book, what does it look like on your end, and what types of things do you look at that a regular investor at home doesn't really have access to?
Yeah, exactly. And we get calls and questions about this all day long, even from advisors or even more sophisticated users. And they'll come to us and they say, hey, I see the spread is 10 cents wide, or I only see this many shares, 100 shares available in the offer, and I want to buy 10,000. Is that going to like move the price? And I'm going to get a bad fill or a bad trade. And Other questions or concerns saying around AUM. I only see $5 million of AUM. Is that a concern? And I only see trading volumes of averaging 5,000 shares a day, and that's not enough to make me comfortable. Um, but again, we look at these things very, very differently. We have multiple trading systems. I don't even know the count of how many trading systems that we have, and we look at, and that goes into everything behind the scenes that you don't see. But the reality is that the order book for most ETFs are quite deep. In Canada, there are 6 big banks that are all major liquidity providers. That means we're out there and we're competitive with each other. So if there's any perceived advantage in the market, it will get kind of traded away again because of arbitrage and because someone will see it's out of line and they will step in to put that price back into line. And so looking at the order book, we see very differently. Depends on the ETF, but there can be as many as 30, 40, uh, quotes levels deep within the order book. And then the price point at which those change also it goes very deep. But again, this comes back to how should I, as an individual investor, best interact with that availability if I don't have these sophisticated, expensive trading systems myself. Again, it's understanding the liquidity of the underlying, using a limit order, and if you're transacting in international securities, make that a consideration as well, because typically our ability to quote will improve. Again, if markets are open and we can access that liquidity a little bit easier, that will make for tighter pricing.
Right. So an ETF with underlying like large cap US equities or Canadian equities is really, really liquid. But then maybe an ETF with an emerging market bond in the fixed income space could be a little less liquid. Although the ETF's still providing more liquidity because bringing access to things like bonds that direct investors usually don't have access to.
Yeah, absolutely. I think that's a really important key part to highlight on well is that ETFs are an access vehicle. And a lot of the times for you to go out and individually transact in the same fashion would be far more expensive than it would be crossing a small spread in an ETF. Again, because we have this institutional access, anything that we're going to be able to price and create is probably going to be much tighter and easily accessed through an ETF. So really, I'd say also don't be scared off. Use a limit order and kind of understand the creation redemption mechanism and how that's going to be able to provide additional liquidity and for you to be able to transact, buy or sell an ETF at a price that is fair.
Thanks so much, Valerie, for taking the time. I'll let you get back to keeping those ETFs liquid.
Yeah.
Thanks for joining.
Awesome. Thanks, Danielle. I appreciate it.
And that's it for us at ETF Market Insights. We'll see you next week.